All right, we still have not had any sizable volatility come into the market. Still waiting. Tagged, obviously, my stock bond volatility ratio, but it has not reversed. I have called that it would be very choppy from March until July and basically into Q3. So I'm still holding that we're just going to be in a chop fest of high volatility until then. So then we'll see what happens in Q3. But in the meantime, I think we're just going to be really bouncing about from literally March, April. We've got lots of extravaganza, central bank meetings and FOMC on March 17th. We have oil spiking higher with yields. What I'm looking at is a little bit something bigger in the oil patch. And Thursday, I'm going to have Robert on. And you know, I populate Slack with some of these concepts as well. But growth to value rotation, big picture, is still in play. Reflation trade above 0.666 is still in play. We're at 1.61 this morning. I mentioned, back that this short covering rally, which September 4th was the peak high, and it has rolled over. That was my price target. That's where I said it was initially going, but we had a whole mountain to climb back down. We've climbed, if you will, in this oscillator, but we still have to get down here and base and turn before we can go higher. So we got some miles to go. This is like a train. It does not, and I mean a fully loaded train that needs miles to go on the track before it can come to a stop. This is what I view the growth versus value. So this is still in play. Really got into, and my intermarket stuff, and I'll show that to you in a minute, is intonating we could go a lot higher in oil, and that kind of freaked me out. So last week I had to pivot going, so I really thought we were going to tag and come back down and stay below on the weekly. We didn't. We closed above 65.65. And I told you that was my line in the sand. So I'll have to rethink this whole oil thesis. So I dug in and read all the Wirehouse reports, and I'm like, oh, I haven't seen these before, but okay, whatever. It's supporting a narrative, obviously, in regards to Morgan coming out again this morning, JP Morgan, Morgan Stanley, Goldman. All that is, oil as an inflation hedge. And I get that. But my intermarket stuff is saying, wait a minute, if we can get above 65, we can go to 80. If we can go to 80, we can go to 100. And believe it or not, a doubling of this. Now, I know that sounds really unlikely. We do not want crude. In particular, it's a headwind above 65 bucks, 70 bucks, 80 bucks, maybe short term, but then it needs to come back down, or we have a serious headwind for the economy and stuff will break. But I hate to say it, but dang it, if you've been a client for a while, this has been in play for a while, and this puppy is still bullish. So this is XLE to SPY. It's not even, I should do XOP to SPY. I bet that's even stronger. But the point is, this is still working extremely well. So Exxon was 32.60 then. You know what it is now, much higher, right? 55 on its way to 60. This just looks very solidly like it's in place still. So I have strength in my intermarket where I thought, and this was my thesis 2 weeks ago on a Thursday, I don't forget what day, 27th or something. I said, I really think we're going to tag this and come back down. And we're going to, retest this before we go higher. Nope. That'd be no. That was a solid no. So I really thought we would have some pullback, digestion, and then spike higher and move higher. We just had a spike higher. So I'm putting things in perspective. My oil read is still bullish. This has been a fabulous, fabulous intermarket read to go short oil. Never expected it negative. I had 10 bucks. Long oil reflation trade, we caught it in June, and then down here again when, again, Exxon was 32.70. CPE, even most recently, a month, end of January, beginning of February, started populating in Slack. It was at 14.50. It's now 40. That has gotten way overheated on expectation of, this fiscal coming in and supporting the energy plays. In particular, 60% they are looking at right now. Citi came up with this chart. I'll show you of 60% of stimulus is going to go towards commodities. Anyway, I've got tech rec in here, which did time that well when the rate volatility seeped into equity volatility. I said VIX is not in play, but NASDAQ certainly is, and the high tech flyers and Tesla and Apple was the first one to give me that absolute clue. Anyway, but then I have on top of that political, fiscal, monetary regime change. Biden not a fan of Saudis and putting pressure there. You can see what's happening also with the dollar higher and the dollar Wuan, USD, CNH higher. That's been a call for the past month as well. So that is increasing. And I also mentioned I can still see the dollar and stronger relative to the other currencies, whether by design or default, even with higher oil. So that's just because something's going on in the oil patch that looks very stimulative, and it's not going to be offset by US shale producers. That's a big deal, because last time they did come in and they're trying to practice restraint. Anyway, gas at the pump, I don't know if it's going to reach, by $100 by summer. We've had this, $10 a barrel rise per month kind of speculation in the past, but I do see some of the supply issues creating this inelasticity that will support higher oil. And then fiscal stimulus, absolutely to help, can also increase this bid in commodities. And then you have the hedge is not gold, it is not bonds, it is not volatility, it's oil. So you have, I just think, a lot of things. Also, CPI numbers are going to drive, higher gas, which we've talked about in the crack spread world, is absolutely driving higher CPI numbers, which is driving higher yields. The whole thing, to me, just looks right now a little bit stupid. High potential for oil if it stays above 65. Otherwise, I can see a high probability short at that level. So here's some of the macro stuff that I grabbed, oil as an inflation hedge, carry as hedge, and oil still comes up as top tier. It definitely dominates other commodities when it comes to CPI. So I'm seeing lots of benefit here to keep an eye on higher oil, which, by the way, at some point will shriek higher. If it does get supported with all of these themes, right? It will likely be a spike high and then crash lower with a lot of energy, but that's later. So I'm seeing Q3 as really worrisome. Speaking of future dates, I'm looking at backwardation as a prediction of oil price. And this is a very good read by Michael Cow. He was actually on Real Vision, and he's under the radar. I found him on Twitter recently. I forget who even, I don't know how I found him, but I have been following him, and his line of backwardation thinking was just like, yeah, I can see that. It's already $20 higher in the future. That's a big crack spread difference also, which is helping the refiners. So I kind of get into this already. I've already talked about the stuff that I like. 1, 2, 3. So Exxon, the E&P plays, the oil refiners, when the crack spreads widen. Well, crack spreads are widening with this oil rip, and the implication that gasoline will go up even faster than oil and will drive a feedback loop of making CPI rise faster. That was basically kind of the major thesis. And then in Slack, I populated the ARC holdings because they are definitely high growth, zero dividend names versus the high dividend, low growth oil and gas plays, which have been in rotation. So that's what I got really into this weekend. So here's my summary. I'm also reminded, which is fascinating, back in November 2019, I wrote, one of these days, stocks, bonds or stocks without a circuit breaker, that we would have this bond bubble be unwound. And I didn't even think about this article until I was researching something on my website, and I brought this up and I'm like, oh my God, that fits perfectly with today. Okay, it's going perfectly to plan when bonds roll over, structurally forcing rates to pop, then oil spikes with the reflation trades, think inflation spike, while momentum stocks are sold off because they're overvalued relative to value and cause indices to correct. By the way, we are there. This might be a a mini version of it, but bonds are already down 20%. And you can already see what's happened with some of these high growth plays, which, by the way, looked extremely bullish intraday on Friday, but my intermarket said no. So I want to go over those two real quick. So this move could be quicker than folks think as liquidity is challenged in bond sell-off and volatility in the bond market spills over into equities. Oh my God. So this is not my first time of using that expression. It's kind of a base mode of operation that when I start to see volatility come into the rate market, I time it like I'm watching on my watch. How long is it going to be before this spills over into equities and those bond proxies of high tech, big tech, whatever, high momentum, zero, dividend players start to roll over? So that happened, right? And I kept getting asked, why aren't you bullish VIX? And I'm like, because it's not where the action is. It's going to be in the bond proxies. So that is repeatable. This is just it's a mode of operandi. I think this is in play right now. How deep it gets is another question. And that brings up yield curve control. It is something that will be intonated, whether it's rate cap, yield curve, forward guidance, blah, blah, blah. If they are ignorant to what's the rate of change that's happening in this market right now with bonds shrieking higher, then that's on them. But if they do anything, and I'm talking about this particular chart, which I have shared, right? And my bond short yield pop. And I thought we were going to have a bounce at 137, 138, 140 area because of how extreme, right? This is, but I don't think this is so, this is clearly not happened. Oil clearly has gotten above 65. So that's where I have to pivot. I can't do anything else but kind of say, okay, so I timed the bottom and this meat, but not the top. So it's not reversing yet. And this is a huge, big problem. This is a inverse head and shoulder, which I have had up on my chart on this 20-year treasury, way oversold. At some point, it's going to get above. And I said that, right? But did I expect it to reach 100 rate of change move? Never has this happened before. Never. We have a problem. That's a bond bubble that's clearly unwinding. The door is very, very tiny. And you can see it obviously in price action for TLT. And now we have bond shorts, even they're not done either. They're just like, look at this crazy. And I put this in Slack today. I grabbed this from Bloomberg. Short sale of the century. And then you have my 100% rate of change. So stuff is under the surface looking a little, difficult as it relates to the plumbing. And this is why I put this together, because I'm looking at my intermarket stuff and, energy is already outperforming tech. So that hedge on inflation. Bonds are continuing to get shorted. Now the dollar's starting to move higher. I think even as Fed promises to be accommodating, market is repricing rates higher, and with it oil. Higher oil risks the U.S. economic recovery, something which the Fed has little control over, and higher oil, inflation, and U.S. dollar is de facto tightening, which presents a growing risk to risk assets, and why the growth to value rotation thesis can continue much higher than many expect.